Hello, and welcome to the October 2022 Economic and Market Update presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. September was another bad month for financial markets as they resumed their downward slide after a bounce in July and August. Continued worries about a recession, coupled with high inflation, kept investors on the sidelines. Stock markets both here and abroad were down between 8 and 12% for the month across the board. September also capped off a weak quarter, with stock markets around the world down and with even fixed income markets showing losses for both the month and the quarter. The primary driver behind the continued declines was interest rates, which rose sharply again last month after Federal Reserve Chair Jerome Powell gave a very hawkish press conference. Markets reacted by taking the 10-year Treasury yield from 3.25% at the start of the month to almost 4%, capping an even larger increase for the quarter. Higher rates provide for lower stock market values, and with fears of a recession taking down expected earnings levels, the market had a double whammy. Despite the market pullback, though, the good news was that the data for the last quarter showed the economy continued to grow. Job growth was down somewhat, but remained strong by historical standards, driving increases in both personal income and spending, and both major measures of consumer confidence rose. Business confidence also remained healthy throughout the quarter. So overall, while there is some slowing, last quarter's data shows that a recession remains unlikely in the near future. But while that's good for the economy, perhaps surprisingly, it also ups the risks for markets. A stronger economy means inflation continues to be well above the Fed's target, and the inflation news last month was mixed. There were some signs of improvement, but they were offset by faster shelter inflation growth. And that conflict between rates and growth sets the stage for the rest of the year. Because the question will be how fast growth slows and how the Fed reacts. While the Fed has clearly laid out its plans, it remains to be seen just how bad the economic damage will be and how the Fed will react to that. Right now, markets expect both substantially slower growth or even a recession and higher rates. That's certainly possible, though, but the pessimism also makes positive surprises more likely. With expectations depressed, we don't actually need good news for markets to rally, just less bad news. And toward the end of the year, that looks possible if the Fed reacts to slowing growth by moderating its policy tightening. Beyond hopes that the Fed will back off, though, there are other solid reasons to be more cheerful as well. We do have solid economic performance so far, as well as signs that inflation may be moderating. Both of these trends, if sustained, should provide support for markets. And looking forward, future returns after a market pullback have often been positive, often significantly so. So with valuations now close to fair levels, there's less risk there, and while the earnings risks are real, as the economy improves, so will the earnings. It's been a painful couple of months, but as painful as it's been, that also has set the stage for future growth. Now, that's not to say we're done with turbulence. Markets are still struggling to interpret everything that's going on, and the potential for more bad news is very real. But despite the headlines, many of the risks may already be priced into the market, meaning much of the damage has already been done. And that's the bottom line. The downside risks are real, but there are also upside opportunities over time. The big picture is that this too will pass. Market turbulence is normal, but as investors, we should keep looking at our long-term goals and not the short-term gyrations. That's it for this update. Thanks for watching. Join me in November for the next one. But until then, be sure to check my blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. We are getting through this together.